Hello and welcome to this week's webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held live on Wednesday, July the 19th at 12:30 in the afternoon. So this is a webinar that we do every week on a Wednesday lunchtime, and it's a quick look at what's going on in the markets and also levels to watch out for, potential opportunities in the days ahead. And we also have a session on strategy. And this time around, we're going to cover what I think is a really important topic and where to set stop losses. I think we all know that we should set stop losses when we do a trade. So we set an order that gets us out if things don't turn out as we were expecting. But I think a common frustration amongst people is setting a stop loss, doing a trade, bang, and get stopped out, and the market goes the way you thought it was going to go all along, which can lead to frustration with stop losses, conspiracy theories about the market or the broker being out to get you, or that sort of thing. So we'll try and look at maybe a healthy approach to setting stop losses. I'll talk about some trades I've done over the last week as well and why I decided to set the stop loss where I did. So we'll do all of that today. But I think that risk warning has been up long enough now. So let me just flip over to the trading platform. There we go. Hopefully you can see that on the screen. So we'll start off by looking at a few markets, then we'll go and do our theory of stop losses, then we'll look at some real examples, then we'll look at some more markets. There's quite a bit going on. I thought we'd start off with the pound. Maybe if I make this is a trade I've got at the moment, the pound, but let's just look at what's been happening. So it was a big move yesterday. We saw UK inflation data come in. I can't remember what the number was, but it was about 0.3% less than expected, wasn't it, yesterday morning? So it came in at 9:30, so weaker than expected inflation. And you can see the reaction from the pound, just before the number came out. The pound had pushed out to its best level, just about its best level, that spike up on that candle, so just about its best level since September, early September of last year, and we saw quite a sharp reversal off that level. There's the number coming out. So it was trading around about 130, 120, and in the course of the next half an hour, 40 minutes, it lost about 100 points. So it was sent down to 130.20. So we saw quite a big reversal off that number. To be honest, as far as I'm concerned, I think it's something I've been mentioning, I think, for most of this year when it comes to the pound. I think it's still a market, pound against the dollar, is still very much in recovery mode. Let's just draw a trend line on. So I'd still be a buyer of dips, any major dips that we had. Yesterday isn't a major dip just yet, but there's our trend, I think, on the pound for this year, off those lows, those 120 lows. Trend line support coming in around about 125.50. Support here you can see from June at 126, support in July 128. So I think if we did see a deeper sell-off from where we are now, back into this zone, it looks like just an opportunity to buy into that trend. But so for me, nothing has changed for the pound. I think the sort of the next objective I'd be aiming for would be, run back up to this sort of level, maybe 134. I think back into this post-Brexit referendum sort of congestion, sidewaysy zone. But for now, at least, I think any weakness in the pound looks like a buying opportunity. We'll come back to this in a few minutes when I talk about stop losses, because like I said, I actually did 2 trades on this yesterday. I've got 1 trade on it from this morning, and I'll talk about the reasons and the stop losses and all that sort of stuff behind that. So we'll have a look at that in a sec. Let's have a look at another currency. Let's have a look at euro dollar. It's pretty much it's a copy and paste job when it comes to euro dollar. It's pushed higher again. When we were looking at this a week ago, that trend was clearly up. Again, the trend for much of this year in euro against the dollar has clearly been up and looks maybe something like that. That's off off the late March level. So we've got solid support ahead of 113. If it slipped back to there, it's currently trading at 115.20. I think we do have those big levels coming in. Let's flip this over to a weekly chart. I think we do have an area of resistance coming in. It's going to be really interesting. Well, really interesting if you're into charts to see how it performs over the next few weeks. So if it's going to run out of steam, we're getting towards the area where we'd expect that to happen. So from 116 through to 117. So you know, 100 to 200 points higher than where we are now could be something of the danger zone for the Eurozone bulls. But let's see what happens. It's a market that's still definitely strong. You can see how quick. You know, these are weekly candles, but you can see how quickly, though, during that week particularly, the market reversed off this 117 level and did it again just over a year ago here. So I think it's going to be really interesting. If we see it start to move through here and hold up at these levels, 116, 117, and then ultimately break 117, I think we have to, you know, get our binoculars out for a much stronger recovery in euro dollar. Maybe, you know, saying 140 back up to here is maybe a little bit optimistic at this stage, but I think if we see a sustained break through 117, it will change lots of people's views versus the euro, you know, and we'll see maybe more of the market shift to being euro buyers. That's a way away, you know. We're still, you know, we'd want to see it hold above there for more than sort of 70 seconds, but there's clearly, you know, a big level to watch, this whole 116, 117 area for euro dollar. Let's just flip it over to the hourlies, and we'll see if there's any sort of levels to watch if we did get a sell-off. It's been an odd sort of session since yesterday. Since yesterday, yeah, where you can see almost every hour, bang, 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 the market sold off. You know, really sort of ground its way back lower. I suppose there's an aggressive trade in there now. If you wanted to be aggressive, if we put our, if we pick up our support from here, when's that? Yesterday morning, 8 o'clock yesterday morning, ahead of 115. There's a bit of support. We'll knock this down to a shorter term chart in a minute and have a look at that level in a bit more detail. But if you really want to be a buyer of the euro, you can be a buyer now at 115.23 with a stop the other side of here somewhere. I don't know, maybe 114.90. So a 30 odd point stop loss there. But if we did, you know, see it pull back, clearly we've got so much support left from the rise from before for euro dollar that, you know, for my money at least, you'd want to be a buyer on weakness. Let's see, we've got, I mean, tomorrow lunchtime we've got the European Central Bank, the latest interest rate decision from the European Central Bank, and as usual, no change expected, but it's often what's said around those announcements that can have an impact on what am I talking about? On the euro. So it's the press conference after, which I think starts at 1:30. I think the announcement comes out at 12:45 tomorrow, then the press conference starts at 1:30, and it's often the interest rate press conference that can cause the euro to move around. But let's take a look at that. Let's have a look at that level from yesterday. So let's zoom in. There we go. So there we go. So we saw it was the early hours yesterday morning. So from about, looks like it peaked about 3 o'clock in the morning, July the 18th, sold off into the European Open, and then sort of bottomed out. Looks like just after 8:30, doesn't it? Whereabouts are we? So yeah, about 8:30. That area was 8:30, and the market starts climbing again. So I don't think it's a ridiculous trade actually to think, well, maybe I want to be a buyer down here. The problem is with the European Central Bank tomorrow, we could see something of a quiet session tomorrow for the rest of the day until that comes out of the way. But it's certainly, I think, for the short-term fans, something of a level to watch. You know, being a buyer here and a stop underneath there. Let's see how it performs this afternoon. But as we've started talking about stops, let's talk about stops properly. Let's do our theory and practice of setting stop losses. So this is where I do my usual, not particularly artistic scribbles. There we go. Let's just bring up a bit of paper. So rule number 1 is you should set stop losses. Some people don't, which I think is silly. You know, if you're doing a trade, you should have a level. Part of a disciplined strategy is having a level where you decide, well, if the market gets to there, then I'm wrong, I should be out of the trade. And the easiest way of doing that is to set a stop loss. You know, there's lots of conspiracy theories and basically utter rubbish talked about stop losses. You know, if I put a stop loss there, my broker is going to push the market to where the stop loss is. Okay, if you're Goldman Sachs, maybe, but if you're Fred Blogs, spread betting, probably not. I wouldn't worry too much about the market getting pushed to your stop losses. You know, it's a sensible part of discipline to place stop losses. So people do start off thinking, okay, I need to place a stop loss. But I think the problem is the stop losses tend to be finger in the air. So we have, let's say, a market that's doing, I don't know, something like that. And let's say the market is trading at 115, and down here might have been 100, and then down here might have been 80 or something. And people will buy. So let's say they'll buy in here, but I think too many people will almost get caught up in what the market is doing now, and think, I've got to, if I don't jump on now, I'm going to miss the move. And they end up placing the finger in the air stop loss. They might say, well, I'm going to put my stop loss at 108. I only want to lose 7 points on this trade, so my stop is going in at 108. Well, first of all, it's good that they're placing a stop loss, because that's a positive. But the problem is, just because you only want to lose 7 points, or 70 points, or 700 points, whatever the number is you decided on, the market doesn't care. The market doesn't care that you only want to lose 7 points. And this for me is really just a finger in the air stop loss, because looking at where buyers came in last time round, well, clearly buyers last time round, the very closest dip we have to what the price is doing now was 100. So if I was a buyer at 115, I would want my stop loss the other side of 100 somewhere, so I don't know, 95 or 90 or something. So I think placing it in what is a finger in the air based on some financial risk that you're happy to take is the wrong way of doing it, and that's where I think it can get frustrating for people, where they end up getting just taken out because just in normal market volatility, and this market can easily do that, and then bang, off it goes again. So your stop gets taken, then you see the market go exactly where you thought it was going to go, but of course without you. So I think we just need to give a lot of thought to stop losses. Actually, it's not a lot of thought. It's just thinking about it from where, if this market goes to this point, I'm definitely wrong. So let's start again. So let's say, and we're going to look at some real markets in a minute and some real levels, and I'll talk through some of the stuff I've done over the last week. But if we have a market that's done something like this, and it's turned around, and you think, okay, well, this market looks like potentially it's turning around. We did have lower lows. We've now got basically the same low. Okay, so if you thought, okay, I'm going to buy in, this is the end of the trend, I'm going to buy in here, and if the market's trading here, so we buy in here, the logical place for a stop loss, if you're saying this is the end of the trend, the market's not going to go down anymore, where should your stop loss go? Well, your stop loss should not go there, because that's just ridiculous. What would invalidate that opinion was if the market did exactly what you're saying it shouldn't do. So you're saying the market shouldn't go down anymore, so therefore your stop loss should go the other side of these lows. Yeah? Because if the market does this and breaks to new lows, then clearly you were wrong, which is fair enough. We're all wrong now and again. So that's the place to have your stop loss. If the market breaks below that low, not some random one because you just think that suddenly, wow, the market is going to do that, and if I don't get on, I'm going to miss out. Let's take this back a couple of steps. So let's say you were right, but you missed the move. So you were busy in a very important meeting, and you weren't in front of your screen, so you couldn't actually pick up on the trade. So you didn't actually buy in there. So you come back the day later, and you find, give yourself a pat on the back, but it doesn't actually put any money in your account, that the market has started moving, that actually you're right, this did end up being the end of the trend. So there are a couple of ways to play this, and first of all, I think the wrong way of doing it is to buy in here and put a stop loss, something like that, because you think, again, the market is just going to rocket higher. So I think if we're buying in here and we think, okay, this trend is gathering pace, I would suggest, because we're only at the start of the move, ideally we'd want our stop loss still the other side of those lows, because trends, they can get quite messy when they come to an end. I'm going to show you some real examples in a minute. We can see markets that just chop backwards and forwards. So I'd say first of all, that's maybe the ideal place to have your stop loss. But in terms of risk reward, it's quite a wide one. I would say the tightest I would want it is under the most recent low. So there. Okay, so pick a point where you're not kicking yourself if the market takes that level out, because if the market does that and then breaks down, okay, you're stopped out, but if your opinion is still valid that this downtrend has ended, maybe you're going to get a chance to buy back in cheaper again, if that makes sense. And of course, for short selling, we just turn these things on their head. But I'd say, the most important thing when setting a stop loss, clearly your financial risk is important, but don't base your stop loss just on how much money you're willing to lose. You should base it on, if the market gets to this level, my view on the market is wrong. Anyway, enough theory. Let's have a look at some examples. So first one I'm going to look at is the Bund. I talk about this now and again, the German Bunds, and I've been in a trade on this for nearly a week now. But also I'm going to look at a couple of oil trades and the pound against the dollar trades as well to try and spread it around. So let's take a look. Let's take a look at the German Bund. And to be honest, it can be any market. It's just it's just the theory that we're talking about. But I'll talk through it because it's one I've been in for the past week. So let's flip this over to an hourly chart. Oh, hang on, if I showed you the screen, that might help. Just hold on a second. My PC seems to be having a little bit of a, strange mood today. Don't know what it is. Let me just bring this up for my watch list. Bund, right, let's bring that one up. Perfect. Right, let's make this maybe a daily chart. Okay, here we go. So this is quite relevant to that whole trend reversal thing. So I put my trade on about a week ago. Why hasn't that moved? It's not happening today, is it? Right, maximize the chart. There we go. Perfect. Okay, so bonds had really fallen off a cliff, but they spent a bit of time at the beginning of July just really messing about and doing nothing. So grinding a little bit lower, but looking like they were forming a base. You'd see over the course of a few days the market sort of pushing down to 160.40. Has a little flip through, then recovers, then it starts to move. So it's here that I was thinking I've got. I wish I bought it back here. Obviously, I think, well, okay, I should have bought it back here. So this is where we can tie it back into that little bit of scribble I just did. If I was a buyer here, if I was looking at the market here in isolation, then really my stop loss should still go under here, because if I'm saying, all right, this downtrend has ended, that low should not be taken out. So I've got a choice. I can be a buyer up here at 161 with a stop loss the other side of 160.30, so an 80-90 point stop loss. Or I can wait and see what happens. And is often the case. Markets do not move in a straight line. So actually the setup, which also I didn't get, was the move back to here. The market sold off. So let's just highlight our level where we're thinking about having our stop loss. We're having our stop loss beyond the lows, beyond there, beyond 160.31. So the market sells off and then pulls away. So here's our better buying opportunity. So we're a buyer here with a stop loss under there. So we're a buyer at 160.70 with a stop loss at maybe 160.20. So we've got a 50-point stop loss. It's a much more sensible stop loss. I didn't actually get in on the bit of the trade I'm in now till here, right? So I don't know what I was doing, what I was thinking of, but I missed out on all of this move here. Yeah, but then the market comes back. But you can see, hopefully you can see the setup there. So when we've moved along a bit, well, you could, if you wanted to, of course, still have your stop loss the other side of 160.31. But it's a long way away when the market's trading at 161.10. You're looking at, again, an 80 or 90 point stop loss. So something I look at, again, this isn't rocket science, but the previous day's high and low is always a good one, which I know I always bang on about. But the previous day's low was somewhere down there, 160.77. A more aggressive stop would have been under here, the dip just before it surged. But again, so the market, so I bought in here somewhere, the market went higher. I haven't moved my stop loss yet because it hasn't moved far enough, but it came back down, and once again you've got this opportunity to buy in, because so this is the day we're looking at here. This is July the 14th, but look what happens on July the 14th. So it sells off, but it holds above the lows from July the 13th, the previous day. So yet again, we see this whole thing, the importance of previous days' highs and lows. So I would suggest, as an absolute minimum, if you're looking to trade, to do maybe a swing trade over a few hours, or maybe even over a few days, your stop loss should be at least beyond the previous day's high or low. if that makes sense. If you're selling, if you're buying, you want your stop loss beyond the previous day's low, and if you're selling, you want your stop loss beyond the previous day's high. And it has borne out quite well. If we zoom forwards, so July the 14th, there's the low for July the 14th. The market dips a little bit lower, but July the 17th, the market moves higher. July the 18th, that was yesterday, it tests that late low and then moves higher, and then today it's sort of gradually moved higher still. But it all starts, I think, a good trade all starts from putting your stop loss in a logical place, so you're not just taken out by the noise in the market. Yeah, so it should really be a big obvious level, like a previous day's high or low. I've also, and let's bring up the price of oil. I've done, if you've been attending these webinars for a long time, you'll know that I never trade oil because I'm just rubbish at it. I always get oil wrong. But I've traded it a lot the last week or so, and I haven't been able to put a foot wrong, which I'm sure I'm jinxing by saying this now. But again, it's a similar sort of thing. This is the price of oil. This is going back to the beginning of July. And it's a pretty similar chart to the one we just looked at, you know, for the Bund. We've seen, so what happens July the 7th? The market pushes to a low. So it pushes down to 43.70, rallies up to 44.70, so we get a 100-point move, pushes back down again, but only through that low by about 5 ticks. Okay, so it pushes through, but there's no real follow-through. Then we manage to rally up and break the previous day's highs. So this, again, is where we have the setup thinking, well, maybe we're seeing the trend end. But again, if we're looking at it up here, if the trend is going to end, it shouldn't take out that important low down there. So if we were a little bit patient, we'd have had the opportunity to buy in a bit cheaper. But look what's happened since then. It's been a bit scrappy here, but over the past just under a week or so, there's been a really obvious level to trade oil off. You know, we've had the lows that were put in here, July the 14th, and I think I bought it here, didn't get stopped out, and the market moved higher. Came back down again, July the 17th. What's the date? I bought it again here, I think, yesterday morning. The market went up, and I bought again last night. I bought again in this sort of messy bit about 8 o'clock last night, I think it was here. But using this level as the one for the stop, so 45.80 as a level to have your stops beyond. You know, it's no good, you know, particularly in a volatile market like oil, it's no good buying it at 46 and putting a 46.66 and putting a stop loss 20 points away, because you only want to lose 20 points, because it will move 20 points like that. You know, we need to pick a really obvious level to keep an eye on. And of course, as it's Wednesday, it's the oil inventories this afternoon, so they're released at 3:30. I think it's a weekly release that can drive the oil market. I think it's always an interesting one to watch. That was the move last week. The big red candle last week was the move on last week's inventories. But let's see what happens. But so for me, so I'm in the trade from, I don't know, 46.20. The market's 46.56, and my stop loss is the other side of 45.80. You know, so it'd be interesting to see if you're in front of the screen this afternoon, you're interested in oil, see how it performs. If it on these inventories, if it gets knocked back. But again, it all starts with picking a sensible level for your stop loss. And the final trade is the pound against the dollar, which I did 2 trades yesterday, 1 winner, 1 loser. And I did one, I'm in one at the moment, which is slightly ahead at the moment. But what I was looking at, this is a little bit different, but it was the move off the inflation data yesterday. So don't forget, so the trend, first of all, the trend for pound against the dollar is up. It was only earlier in the morning, before inflation data, that it had hit its best level since early September. So for me, you know, as a trend follower, I want to use any weakness as an opportunity to buy. So the market sold off heavily on this inflation data, and then it stabilized. And I thought, well, actually, that looks like that maybe the market's overreacted here. So I bought in at about 130.20 with a stop loss at 130.05. So I bought in at 20, and the market about an hour or 2 later took out the stop loss. But again, it went sideways, and I thought, well, okay, it's broken the support from after the number came out, but there's been no real follow through. So I bought again at 130.15, but with saying, well, if this is going to be a base, we shouldn't take out the lows from back here. And it took a while, but the market, you know, pushed higher. I trailed a stop out and I got stopped out for a profit, which made more than I'd lost. And the trade I'm in now, it's basically the same trade again. It's done exactly the same thing this morning. So this morning, here we go, sort of 10 to 9 this morning, it comes back down to this 130.20 level. It holds, so the low from yesterday holds. So again, my argument for doing the trade yesterday, okay, if the market is going to build a base here, it shouldn't take out the 130 level. So I bought, I think I'm in at 130.18 with a stop at 129.90. Okay, and hoping, well, we'll see what happens, but the market is going to claw its all way back up to there. We'll see what happens. But hopefully you can see it all starts with a stop loss, and I think it's picking an obvious level to place your stop at. And I think too many people just pick, unfortunately, finger in the air. You know, they get so carried away with the idea of doing a trade that they place a finger in the air stop loss and wonder why they keep getting stopped out all the time, only to see the market go the way they thought it was going to go. So hopefully there's a bit of food for thought there. On the subject of stop losses, I thought this was interesting. This is German 30, the DAX. So, you know, we all know what stock markets have been doing in recent times. You know, we've seen since the US presidential election, you know, we've seen these markets gain ground, and it looks, look at that, it's almost textbook trend line for the DAX. So again, if you're like a medium-term swing type trader, you would view the moves over the last couple of weeks or so as just the DAX, the German 30, pulling back to its trend line. You know, so if the market is going to rally from anywhere, this is the place. And as usual, the first thing you should think about, well, where's my stop loss going to go? So, and I would suggest there's a really obvious place for the stop loss, because if this trend is going to continue, it should not break these lows. So first of all, we know that, okay, our stop loss needs to be down here. Now, because it's a daily chart and we're looking for a bigger swing, clearly we're going to have a wider stop loss. But so 12.312 were the lows. So 30th of June low, 12.312, and then 12.316 on July the 6th. And it's currently trading at 12.433. So for me, if I was a buyer here, and it's a textbook example, so it is sod's law, it will go wrong, but it is a textbook example so far. So if I'm a buyer at 12.433, I'd want my stop loss, I don't know, where do you want it? I mean, 12.290 maybe. So you've got 140 point stop loss, which is a big stop loss. But if we're looking for the market to rotate its way back up, we've got potentially 500 points upside. So again, there's a more longer term example. But the DAX is an interesting one. You know, stock market, we saw US stock markets again last week set all-time highs. You know, if you look at the S&P 500, you know, we moved out to all-time highs. So anybody, and I'm sure there are lots of people out there shorting the market at the moment. Anybody who's short, they're just getting squeezed and burnt a bit every day. You know, but these markets incredibly strong. 2,400 on the S&P, I think, is a level to watch. When we do get sell-offs, the buyers come back in. So the expectation would be for stock markets to move higher. Maybe not today, maybe not tomorrow, but you know, over the medium term at the moment, there still appears to be an appetite to be a buyer. Let's look at two more interesting markets, then we'll wrap things up. We'll do the Aussie dollar first, then we'll have a look at gold. The Aussie dollar, I think I would have been completely wrong-footed by this if I was trading it, but let's take a quick look at the Aussie dollar, because we've seen a big breakout. So this is Australian dollar, US dollar. Well, actually, it's big on a daily chart, but a weekly chart does put it somewhat into perspective. But it's interesting. It's an interesting one. So here's our long-term view for the Aussie. So these are March 13 highs up here. So let's just plonk a bit of a trend line on there. So we've been watching this for a while, the Aussie, and I had lost interest in it because it just kept failing to break, but now it has actually broken out. So I think we touched on this quite a bit last summer. It kept coming up to that sort of 78 level, running out of steam, 78, 78, 78, and finally it's broken. So again, if we could well be seeing the beginning of a much bigger recovery in the Aussie dollar. You know, if it goes all the way back up to here, that'd be a heck of a move. So for now, you know, I think that's a significant break. This is only the first week of it. So for the longer term people, you might want to give it a bit of time. It looks like only over the last couple of days or so it's broken out. But that really is, you know, quite the show of strength. So I think for Aussie dollar, we'd want to be a buyer of dips. You know, if we see the Aussie maybe weaken after this, let's say it slid for 3 days and then day 4 we saw some strength come in, I'd be tempted to be a buyer on day 4 with a stop loss under the most recent low. But we'll come back to this more regularly now. Now it looks like it's getting a bit more interesting and it started moving. But that's a significant break in Aussie dollar, US dollar. So that's one to watch, I think. And the final one we'll look at, let's take a look at gold. So I think for me, gold at the pound, I expect the story this year to be one of recovery. And we have seen recoveries for gold, but we haven't seen it able to break 1300. And I'm not a big fan of looking at patterns in the markets, but we do have something of a pattern going on for gold, where it marches its way up for a month, then it falls for like 3 weeks, then it goes up again for a month, 6 weeks, then it falls for a few weeks, and so the thing goes on. And it looks like we've completed again. And I think for gold, we've got, again, big support. We had the old support from May left at 12.14. Yes, it did break below it, but it recovered off it really quickly. So again, if I was a buyer now, the tightest I would want my stop is somewhere the other side of 12.04. We've got other support coming in back here at 11.95. So I think it's interesting. It's had quite a run over the last week. If gold turned and sold off back towards the 12.14, 12.20 area and strength comes back in, it looks like an interesting one to trade, I think. But I think my expectation would be for a run back up to those old highs. So there's plenty to be going along with. I think there's lots to be watching there. The stock market's still strong. The DAX is interesting from a medium-term point of view. The Aussie dollar, because we've broken out to fresh highs, fresh highs for the most recent history. Pound against the dollar because of the move off inflation yesterday. So I think there's quite a bit, and oil. If you want to sit in front of the screen, let's see how oil performs this afternoon when those oil inventory figures come out. Does the magical 45.80 level continue to hold? So I think there's a lot going on there. But we'll wrap things up. I'll just put my contact details up. So if you have any questions, feel free to drop me an email. My email address is david@tradeafter.com. Aondo are maybe better known for social trading, where you can copy other traders. And I've been blogging about a real live social account with £2,000 in it, and you can see the progress of that. I think it's up about, last time I checked, just under 10%, I think, since February. If you go to www.tradeafter.com, you can see that on there. But any questions, drop me an email. I hope you found it interesting, and we will, as usual, do it all at the same time next week. And I hope you find that thing on stop losses. I really do think that's where a lot of people go. I think the big mistake that someone would make is not having a stop loss. And I think the second biggest mistake, people set them far too tight. They don't give the market time to prove their trade wrong. They set them in just random areas, so they're just fodder when the market chops about. So hopefully that little bit on stop losses will be useful as well. Okay, we'll wrap things up there. Thanks for coming. Enjoy the rest of your afternoon, and hopefully you'll be around to do it all again next week.